Welcome to episode 2 of the Markets Unscripted podcast. I'm your co-host back here this week, Matt Caruso, with my friend and co-host Jason Shapiro. Great to see you again this week, Jason. I've been looking forward to it all week. How are you doing?
I'm well, Matt. How are you?
Good. So last week we kicked off talking about the market, and there's plenty to talk about. Interestingly, we were talking about a tough tape last Monday, which kind of imploded into the end of the week. But what I want to kind of kick off this show with was what we spoke about yesterday. Was this is the kind of market where it's easy to really get something wrong, and I've been on that side of the tape. It's rough. So just before we get into the actual market and the rest, I thought it'd be a good discussion to have with how I can speak for myself, but I'm curious even yourself when you get yourself back into that corner and you go through that scenario where you kind of get a hit much more than you expected, or maybe you think that you can handle. In the past, what's been your process for trying to come back and kind of rebuild the mental strength and just even next steps with the portfolio? What's your process when you kind of end up in those situations you don't want to be in?
It all comes down to your process and whether you've done a good job of developing a process that is going to give you edge over time, which the only way to know that is to run it and let the returns speak for themselves, right? And then to, I think, have the expectations based on either back testing or live data or whatever for where those returns should fall within, that you're going to have drawdowns no matter who you are. The question becomes, is that drawdown falling within the expectations of what you thought they would be? And if they are, then there's nothing really to do about it other than to just suck it up and say, hey, this is part of the game, which it is part of the game. Okay. If it starts to fall outside of your expectations, then you've got some work to do, right? Because it shouldn't do that. And if it is, then maybe what you're doing is not what you think you're doing. Maybe the edge that you think is on your side is actually not the edge that you thought it was, right? So you've got to kind of go back to work and figure out if you've done something wrong in your testing, right? And it's in that way, it's sort of self-correcting because here you go. I have a process. I've back tested over 30 years or whatever it is, and I've been trading it for 5 years, and it's never drawn down more than 15%. Okay, and it never should draw down more than 15%. Given the volatility that I'm running, right, it should never draw down more than 15%. Well, I just drew down 18%.
Yeah.
Okay, then stop. I think stop trading and go back to work and figure out what's going on, why it's wrong. Check out your statistics of your trades. Have they gone down? Have your winning percentage gone down from 60% to 30%? And if so, is there a reason for that? Or is it just that maybe your back testing was wrong? The story of actual returns coming nowhere near back test returns is as old as back testing is, right? So you have to be honest about it. Did I do something in my back testing that was dishonest? And I don't mean dishonest like you lied, but you lied to yourself, Is there something in my back testing where I did too much curve fitting, right? Because that will show up in the real returns. So I think that once you surpass the drawdown that you would expect, I think the thing to do is to stop trading and figure out what the problem is.
That's always the hard part, because once you get stuck in the drawdown, like it's the natural human instinct to just want to try and make it back quicker and all the rest. But that usually kind of compounds the error and all the rest. I was reading a really good book over the weekend. I started reading this book called The Score Takes Care of Itself by Bill Walsh, the old coach for the 49ers, and how he turned it around. And it's just, there was one part of that book, right how it opens up. And he mentions how regardless of what it is you're doing, if you're in the competitive side of the field, so whether it's sports, whether it's trading, whether you're a CEO or whatnot, there's going to be these really emotional, like devastating periods you have to get yourself over. And he starts off talking about how he just got the job. It's 25 years. He's trying to get this job. He gets it after a few games. He's like thinking about handing in his resignation because he gets blown out by the Dolphins. And he's like, men are not supposed to cry. He's like, I'll be honest, I went in my office, I cried a little bit. And then after how he systematically went back and he had to kind of rebuild the whole team, rebuild the whole process. I found there's just so many parallels, because like we spoke to last week, if you want to cost based build yourself into a S&P 500 fund for 25 years, that's one thing, but that's not the very competitive side of the business. So if you're going to step into the competitive side of the business, which is true of anything, anyone in any realm, not just trading, you have to be ready for those emotional swings. And I think if you can get the swings under control, you're right. Like step one is get yourself back to that centered place so you can make those good decisions. And the problem is people kind of stay committed with the game, and then they never give themselves that moment to kind of like step back, reassess, and try and plan the next moves because they're just looking at where their P&L was a week ago, and then they're still like in panic that they can't believe they're not there anymore, and that really kind of leads to all these kind of compounding mistakes. So I understand where everybody is, and then unfortunately these kind of weeks where, especially the higher moving assets or whatever it is, can get slammed harder than other times, and it feels abnormal, but it leads to that significant mental and emotional strain, which once you're on that kind of tilt, like your point is, it's so important you get back to it. And I know maybe some people aren't even back testing or doing all these kind of things, but I think to your point, like reassess, like what's the strategy? What are you trying to follow? What are you trying to apply? Is there one thing specifically that you'll jump to first, typically, Jason, when you're trying to kind of rebuild? Are you looking at just the series of losers? Is it you run the whole back test, look back if there's any mistakes in curve fitting? What's your first step if you want to kind of guide people to getting back on track?
Stop trading first. And if you can't do that, then I would say right away, you're doing it wrong. Okay? Mm-hmm. If you can't stop trading for a little while, then you crave the action. Mm-hmm. And if you crave the action, that's fine, If you're in a job that you find boring and you're looking for something in your life that creates action and all that, okay. If that's why you're trading, then that's fine. But just understand what that means, mm-hmm. which is you've got a 99.99999% chance of losing money. So if that's what you're in it for, then just understand that. And then when you lose money, don't cry about it, because that's what's going to happen, right? Mm-hmm. You'll get the action. You'll have some ups, you'll have some downs, and when it's up, it'll feel great, and when it's down, it'll feel like shit. But over time, if the action is what you're after, then the action is what you're going to get. Mm-hmm. So you can't cry about that, okay?
Yeah.
And you have to be honest with yourself about this. Nobody will admit that's what they're doing it for. Everybody will say they're doing this to make money. But are you really doing the things that will help you make money? That's the question. Are you really doing the work that really will help you make money? Are you really approaching it in a way that will help you make money? You got to be honest with yourself about it, right? If you feel that you are, then stopping trading when you're in a bigger drawdown than you would expect mm-hmm. Shouldn't be a problem, mm-hmm. right? In fact, it should be a relief, because you can get back to work and figure out what's going wrong and how you can fix that, The idea about Bill Walsh and football and his success and all that, I'm a big believer that there's no difference between success in coaching a football team or success in trading the markets or success in being a good husband or success in anything in life. It's all the mm-hmm. same thing, It takes all of the same disciplines, and why people think the market is any different than anything else always kind of freaks me out a little bit. The market is actually harder than most of those other things outside of possibly marriage. The market is harder. So why you would think it's just going to give you money when you're not being disciplined about every single thing. And that's where people get it wrong. Like I was saying last week, your expectations have to be the first thing, right? And in that realm, with your expectations, like I was saying, should come there has to be a measurement of where it's going wrong, mm-hmm. right? You have to have that somehow, right? Whatever you're basing it on, back tests, real money, whatever, relative to the easiest thing to do is just make it relative to your volatility. If your drawdown is bigger than your volatility, than your annual volatility, well then you suck, or not you suck, but your process probably isn't very good, right? Yeah. So if that's the case, it's time to back off and say, this isn't working. So let me stop. Again, if your goal is to make money, and you got to be honest about what your real goal is, but if your goal is to make money over time doing this, then, a very simple measure. My drawdown is bigger than my volatility. So this thing is terrible. All right. Um, so I got to back off and I got to go back to work and I got to figure out what's going wrong and I got to figure out ways to make that right and get the edge on my side and all that. But
Yeah.
having those measurements of where it's gone wrong, I think is very important.
But you touched on one thing too, where like you're saying how discipline, regardless of what you're doing, is important. And if you look at Bill Walsh, like in that story, he talks about how he wanted to change the entire culture of the whole organization, like from the people answering the phones to the people cleaning the locker rooms, like the way that the players dressed and all the rest. If you go back to, I'm sure you've read the book Reminiscences of a Stock Operator by Livermore, by was it Edwin Lefebvre, about Jesse Livermore. And he talks about how he would go to bed at 10 p.m. at night. He wouldn't go out partying when he had heavy positions because he had to wake up with mental clarity. And I found that really to be true, even for myself, like especially in periods of drawdown. I think people don't sometimes, I think they underestimate even the physical toll it can take. Even if you expect the drawdown, it's never fun to go in the drawdown or when things are kind of going against you or whatnot. So a lot of this, you mentioned family and all the rest. It's a business like any other. If you're gonna open up a business, it's kind of hard to run a business hardcore and not have your family understand what it is that you're doing or have the world around you structured in a way that's supportive of that. So, I mean, for those who are kind of having a tough go and been caught off guard with a lot more, you have to have that time where you can recover physically, emotionally. You have to put yourself in a position where, like you're mentioning drawdown, go back to your studies, is the drawdown you're taking on, even if it is within what you expected, is that something you can actually live with? Because sometimes on paper, you can run all these things and it's a great system, but then in real life, you just can't live with that. I've met so many people where, I have this great system, I love it, and it does, better in good times and bad times, this and that, but then they try and apply it and they blow up because they can't personally withstand the swings. And I think that's just a core part of anything at a competitive league, but especially for trading, the fact that you have this constant scoreboard of all times of how you're doing and whether you're doing bad or good and everyone else. And it's like an emotional train wreck for anyone that's not used to it. I don't know about you, but I think a lot of the tools I use today is stuff I earned early on. And it was just like years and years of just refining slightly and controlling myself. And it's a lot more difficult than I think people would allude to.
The mental part of trading is the hardest part of trading. Trading is extremely hard to do to begin with. Picking whether the market's going to go up or down, or and trying to figure out where you get edge in that and all that. Very, very, very hard to do. And that's the easiest part of this game, because the hardest part of the game is the mental game. I catch crap from a lot of people because of my drawdowns. Because I don't draw down more than 5%, at least to this point I haven't. And it doesn't make sense, because if I can draw down less than 5% and make 15% a year, then why wouldn't I triple that and draw down 15% and make 45% a year? And I explain to people that that's just not how it works, because my mental capacity is not very high for drawdown. So
Yeah.
if I were to draw down 15%, I wouldn't be around to capture the 45%, because I'd probably put a bullet in my head because I couldn't take it, right? It's just how I am. I'm very low capacity at this age, at this stage in my life, at what my life looks like, at where I am, the money I'm at, blah blah blah. I'm not at a place where I can deal with a 15% drawdown.
Yeah.
I'm at a place where I can deal with a 5% drawdown. So that obviously limits my returns. But you know what? That is what it is. You know, I don't need to make 100% returns or ridiculous stuff like that at this point in my life. I'm looking to make steady returns with small drawdowns. So you're right. People don't understand that. It looks good on paper. Hey, my return to drawdown is 5-1. So if I draw down, 30%, then I can make 150% a year. That all sounds great until you're drawing down 27% and you're about to, kill yourself and quit the game, right?
Yeah.
And there's no way to know where you are with that until you get there, right? Which is usually too late, because, okay, now, I just found out I actually can't draw down 30% because I did, and I can't take the emotional burden. So I'm going to cut everything in half. Well, that means it's going to take you twice as long to make the money back, which psychologically is going to be very difficult as well, right? So yeah, all these things are extremely important and extremely, extremely difficult. I always believe in things like under promise and over deliver.
Hmm.
And I think that that's what you need to do to yourself when it comes to trading. You need to come in here knowing or believing that you have a very small chance of it working. And maybe that'll help you with your risk management, right?
Hmm.
To come in and think that you're the genius that's going to make 100% a year for the rest of your life, you're setting yourself up for disappointment. Okay. Um, we talked about it last week. Your goals have to be realistic, first of all,
Hmm.
because if they're not, then you're doomed anyway. So yeah,
I,
all these things are extremely important, almost impossible to learn
hmm.
other than live time, right? And the unfortunate reality is the only way to learn it live time is that you have a big drawdown. That's just the unfortunate reality, right? No one's going to listen. I didn't when I started trading. I wasn't going to listen to anybody. No one's going to listen to anybody. If you were to listen to anybody, you wouldn't do this to begin with because you're playing a game where the odds are very far against you. So if you were to listen to anybody with half a brain, you wouldn't do this to begin with. So clearly, just the fact that you're doing this means
Hmm.
you're not going to listen. So the market will make you listen.
Yeah.
Or it won't, and you'll just blow out, and you'll lose all your money, and then you'll really listen because then you won't have a choice anyway.
Well, it's interesting because if you look at the stats of what I think are successful traders, and the same with successful entrepreneurs or company, I mean, most entrepreneurs who start a business, most do fail within the first 5 years. I forget the stats if it's 90% or. I think those are. There's so many truisms. I feel like trading, if you do it to the level that where it's your life, like like I've done for my career, like you've done. I feel like it supercharges your ability to learn about life and the truisms that go across disciplines in different ways. And so, I mean, anything's possible. And that's why, Jeff Bezos is as wealthy as he is, and every other entrepreneur who's done well, because you're the few that's able to get through. So just realize what you're chasing. I mean, like you wouldn't go in and open a store, uh, planning to put in 10 minutes, a day or, 20 minutes a week. No, you say that have to be my full go at, and I'd have to study and look at all the different things. So yeah, just so important. And so if people are in drawdown and whatever it is, not like just realize, there's a way to get it back. But the first step is to really get yourself kind of reacquainted with the right process, the right sizing for you. I mean, I can't trade like you. You can't trade like me. I think we're all built differently in terms of our risk appetite, risk tolerance, and getting that right, which again, you only learn with time in the seat, is an important step. I find the more I go on, I think the more the way I kind of judge the success of a trader is it's twofold: how much you can make, but also how long you can actually have a career doing it. Because most can have a great 6 months at any point in time. Doing it for 10, 15, 20, 25 years, that's the real, I think, magic, because that'll test you at every element of the process. Uh,
Anybody can make money in the market
yeah.
for any period of time. It's the rare person that can keep that money.
Hmm.
I mean, you talk about Jesse Livermore. Great book, very very entertaining book, and there are some trading lessons in there. Look, when I was younger, I loved that book. And when I was in Hong Kong, I mean, I was a 20-year-old kid and I was going crazy. They used to call me the boy plunger. And I named my first son Jesse.
Okay. Interesting.
But if you really then grow up and think about it, Jesse Livermore died broke
Yeah.
and committed suicide. So let's not forget that,
Hmm.
okay? Hey, it's all very exciting. The book was very entertaining, and he was, going fishing off of yachts in Palm Beach, and he made $100 million on the crash in 1929, and whoop-de-doo, that's what I want to do. Do you want to die by shooting yourself in the head because you were broke?
Hmm.
Is that where you want to end up? Because that is your fate if you want to be like Jesse Livermore. I think
Hmm.
that's something that's important to understand,
Yeah.
right? It's all very romantic, right?
Hmm.
And his life is very romantic, but he died of suicide, broke.
And also
And his,
to the
and his
discussion.
granddaughter, by the way, is a pretty famous porn star. But anyway,
Okay. Now, I'll say, but to your point is, he was notorious as well of having a terrible family life and all the rest, and drinking, and his wife and all of from.
and that's just it. You know
Yeah.
what I mean? This is what people forget. This is what people forget. This is not It's not what it's made out to be.
Hmm.
It's just not what it's made out to be, And you better think about all those things because it's so cycle. All those things are going to affect you.
Hmm.
Your home life and your life with your wife and
Yeah.
your life with your kids, and it's all going to affect you psychologically.
Hmm.
And all of that is going to get you off of the discipline of what you need to be doing in order to make this work. And the margin of error is so very, very, very small
Hmm.
for mistakes in this business that you better know exactly what you just said. You better know this stuff because it's all going to line up against you. And maybe that'll give you a good excuses for failing. Oh, well, my wife didn't support it and, I blah, 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 blah. Okay, fine. But maybe you better know that before you do it rather than
Hmm.
after. But again, you're not going to know it before because you're not going to listen because you're not going to believe it because you wouldn't get into this to begin with if you were going to believe that stuff. So,
Well,
you know,
one of Bill Walsh's rules to get back in the game is don't blame others, which is like an important part of this business. You got to take responsibility and fix and structure yourself properly. There was one trader I had learned from. He was a trader from the Philadelphia Exchange, and I remember him saying, if you lose too much money, you can't trade. If you make too much money, you can't trade. I remember I was like, 21, 22. I was like, what is he saying? If you make too much money, you can't trade. Like that's what a ridiculous thing. Like why am I listening to this guy? But he was pointing out the requirement of the emotional balance. If that goes off, you're in big trouble. And the problem is that you kind of sow the seeds for your defeat in the good times. No one was worried about markets a month ago when everything was rolling fine. If anything, they're probably still ramping up leverage. So always trying to keep that balanced neutrality is just so key. And I think it spans across your life. If you want to make this a real business and you don't want it to be something that just boom busts and that's for entertainment and all the rest, again, I think the core principle is it's got to be run like a business process. It's got to be from the top to the bottom, structure, discipline, and I think that's where you get your chance to kind of be the few that do really well versus most who don't. So that's
I,
just my
I believe that to the core. My whole
yeah.
life is almost everything that goes on in my life
Hmm.
is centered around that very idea.
Yeah.
And it's stupid in a lot of ways because what's the point? I'm trading to make money, okay?
Hmm.
Clearly, that's what I'm doing, right? It's about the money. But you know what? I don't spend any money. I don't even need the money. But one is the other, right? The fact that I don't spend any money means that I don't have financial pressure,
Hmm.
means that I can ride out the drawdowns and get to the good times, right? Because I don't have any loans. I don't have any leverage in my life. I don't spend money above my means. And I've been that way for a very long time, right? That's what increases my chances of being successful in trading. One is the other,
Yeah.
and it seems pretty stupid. So what's the point? You know, what's the point of sitting here trying to make money all the time if then you don't spend any of it?
Well, it's balance. I mean, obviously, we still want to have a good time. You want to enjoy life, but it's same with me. Some of the best traders I've traded with that I know that have blown up. It's because they overspend the good times, and you get these habits that you can't sustain and draw down, and again that leads to maybe it's your wife who's saying like, "What do you mean we can't go on this lavish vacation that we took 3 times last year because your Nvidia trade didn't do well?" So it's all linked, but it's the right. I think that the right amount of spending is part of the balance. The kind of drawdown you take is the right kind of balance. The kind of position size is part of the balance, and that's got to be figured out for each person. But it's the full cycle you got to get through. It's not just the ups leg. It's not just the down leg. It's the chop. It's the drawdown. It's the month by month like lifestyle needs that you have. When you solve all of that equation, then it's a beautiful thing. But those are all. I mean, we always look in the books. We always learn how to interpret a stock chart, one stock chart at a time, and then suddenly you're dropped in the market. You're managing a portfolio of 10 stocks with things coming out that you didn't realize, with life pressures and a tax bill and life life drawdown, and it's a whole different equation. So taking a step. That's why I think for the vast majority of people, even if you are going to trade or you want to active trade or get into the business, unless you're backed by someone who's giving you capital and you have some experience already, or the money's not important to you. For most people, this is something you should, if you have money coming from somewhere else, that's the best way to kind of start learning this business. Because if you're going to try and jump in with 2 feet without adequate experience on the whole front, including the lifestyle part of things, then you've just made the whole business even harder for yourself.
It's a horrible primary income. Trading
Yeah.
is a horrible primary income.
Yeah.
Horrible for all those reasons. for all those psychological reasons. You need to, as soon as you need to make money to live, your chances just went down by a lot.
Well, speaking of Livermore, there's the story where they wanted to buy this fancy coat and they were all trading to make the money to buy the coat. And everybody, he finally went out and bought the coat and just said, here, whoever wants to take it, because we're all blowing out trying to make this money for this coat. So it's, again, a 100-year-old story is still true. That makes it a truism in my book.
I mean, that's what is good about that book is the stories in the book are very valid. It's all the psychology of it all is very valid.
So let's take a switch over. Let's hop over to markets. Let me get the screen shared here so we can take a look at how markets are looking. Last week, like I mentioned, we were speaking about NVIDIA coming up, market weakness, soft tape. This is NVIDIA. They reported earnings, which were great earnings, but then after people didn't like, I think, buildup of inventory and cash flow questions, not the reaction people would have wanted to see. But looking at the market as a whole, I'm trying to understand. My thoughts have been, I don't know at what point you've looked at. We're going to talk about the carry trade after. I know you want to speak about the yen. But although so much attention has been on NVIDIA and AI, because those have been the hot stocks, I think there's been like this strong credit issue building in the background. If you take a look at Bitcoin, which we've been saying was also very weak last week, interestingly enough, there was Tom Lee on CNBC talking about how some market makers got slammed with positions on this break way back in October, which is putting pressure on the trade. At the same time, if you look at stocks like Blue Owl Capital, which is private lender, private credit, they've been under a whole lot of pressure and all of that. And then if you take a look at some of the AI stocks that are more capital intensive, like a CoreWeave, where they have to build out these data centers and then rent them out, but there's high high money demand. Same with Oracle, where they had to sell bonds to raise money to finance their AI ambitions. These are all the stocks that got slammed by far the hardest. So if you look back at NVIDIA gets all of the news attention, but this has been fairly calm. And one thing that I watch very closely are the high yield bonds. If we take a look at JNK, we just adjust that for dividends. If you adjust it for dividends, this has been pretty steady. If you look at a close only chart, I mean, we're not far off our all-time high. So I'm just starting to question here, is this more of a meltdown in like the private credit thing that's been spreading between crypto, which was over-levered, the AI stocks which were over-levered, private credit maybe which was over-levered, which caused a washing out? Because we did see some signs. If you take a look at Bitcoin on Friday, there was some pretty record massive volume here. I don't know if it's record. It was a record on the IBIT ETF. So some signs of maybe capitulation, which would be interesting as it happens when all the bad news stories come out. But curious if you've been looking at it from that angle at all, Jason, or just looking at them one by one. That's just kind of the mosaic I've been piecing together over the past few days to figure out if this is spreading or if it's more localized in the high stress parts of the market.
I think that most of the time, the biggest story and the most important story, and you'll hear me say this as we do this all the time, is liquidity. That's all it is, man. You know what I mean? It's not all it is, but it's a very, very, very big part of what this is, right? If there's plenty of liquidity, then assets are going to go up. And if liquidity dries up, then assets are going to go down. All right? And just like you pointed out, so what started to go down? All the things that are most reliant on liquidity, right? NVIDIA probably is less reliant on liquidity.
Right.
But those ones like you were talking about that have to borrow a bunch of money and then have to spend a bunch of money and, all that. Bitcoin is certainly a liquidity play because that's all it really is a liquidity play, right? Mm-hmm. All of those things have been getting weaker, which is to imply that the liquidity is drying up. I think that's all it is. We can build 1,000 narratives and 1,000 stories that can make us sound really, really smart, maybe, but I personally think that that's all it is. And the thing about the liquidity is that it's a tough game here because given the stated intentions of the people that are now sort of in charge, they are not going to give up on liquidity. They will just provide more liquidity. If there ends up being a liquidity problem, then they will just come out and provide more.
Hmm.
So on the one hand, if you're seeing liquidity drying up, which it was clear, we talked about it last week, and I've been
Yeah.
talking about it for a few weeks now, it was clear liquidity was drying up because things like Bitcoin were failing, right?
Hmm.
And the things that were very liquidity based were failing. I don't unfortunately have any way of modeling where liquidity is going to be in a month, because I don't think it's possible to do that because, like we talked about again before, the velocity aspect of it is a big part of the liquidity, and there's no
Hmm.
way to forecast what velocity is going to be, right? Even if you could forecast what M2 growth was going to be, even if someone gave you what M2 growth was going to be beforehand, you would still have to know the velocity of that M2 to know what liquidity was, and you can't. So rather than try and build a model or that predicts that, I just like to look at it in the markets and let the markets tell me. The markets tell you what you need to know. And
Hmm.
it's been quite about 3 weeks, almost 4 weeks now, that the heavily reliant upon liquidity assets have started to fail. So that alone tells you liquidity is drying up. Does it mean that liquidity will continue to dry up? Does it mean that liquidity will not come back next month? No, it doesn't mean that. But it showed us very clearly a few weeks ago liquidity was drying up. Um, to me, it's that simple. But again, they're going to come in. I don't know where. If the market were actually to have a real fall, and in particular, I think if the fixed income market were to have a problem, then they'll come in and they'll provide more liquidity. So how are you going to short? When the more it goes down, the more chance it is they'll come in and print more money or do whatever they're going to do and provide that liquidity back. They cannot afford anymore
Hmm.
not to do that.
Hmm.
This whole thing is what saved everything. It's what saved us in '08 when they printed a whole bunch of money, which at the time seemed like a ridiculous amount of money. Now it doesn't even seem like it was that much. It's
Yeah.
funny. You go back and you hear them talk about it. $800 billion. Oh my God! Like it's nothing now, right? But at the
The
time,
Elon Musk pay package.
no, exactly. So it's like, you know, that's what they did to save '08, and now they have learned that that's all they have to do to save everything. That's what they did to save the whole COVID freak out, right? Just print money, right? And that's what they will do now forever. And that's the only thing that has helped. Although maybe the AI revolution, we could argue, has helped too. But for the most part, that's what's done it for them. So now they know that's what you do, and they're always going to know that's what you do.
For those that are a little newer to it, just when they speak about liquidity, I think it's hard sometimes for people to kind of understand, well, this money's out there. How is it gone all of a sudden? Just for those who are a little less like used to looking at it from this angle. Ray Dalio has some good stuff on this where he was talking about it. There's a YouTube video he has called, I think, how the economy machine works or whatnot. I forget. I would check it out. But he goes through there. It was a good, simple explainer. I try and use when I explain to my kids. But basically, if I go to Jason's bar and I take out a tab, and I owe him $1,000. Well, I drank the beer. I'm happy. He thinks he has that $1,000. He goes to spend to buy more beer. That supplier has that money, and he says, "Wow, we're really booming here. We have to ramp up our capex so we can make even more beer because we're in high demand versus all the other beer providers." And so all this circle starts to happen. But then after, suddenly I lose my job and I say, "Oh, okay, I got to cancel that beer. Sorry, Jason, I'm no good for the money. I can't pay you back." And that sets off that cascading like credit cycle where all that kind of money then gets destroyed. So, everyone looks at what's money, which is M2, like what Jason's talking about. But the biggest driver of this liquidity is that multiplier effect, which is credit. And credit comes in. It's not just the bank. It's even as something as simple as a bar tab is you can provide credit to your customers if you want that way there. It's off the books. It's a black label financing, but that's essentially what it is. And when things go bad, that's how this domino effect kind of takes place. And that's, in reality, that's really what the Federal Reserve was first created for, was supposed to be that lender of last resort to stop that domino effect, which now, of course, they've gone into a billion other avenues of what they do. But the whole idea originally of the Fed was like, okay, if this domino effect happens, which happened in 1907, and JP Morgan, the man, had to go in to stop it, you say, look, we don't want to rely on a person. Let's rely on an institution. And that's the original idea. But that's just how powerful this breaking down, especially with fear being more powerful than greed. It's just an incredibly powerful thing that ideally should be stopped if possible. But then again, taken to the other extreme, like you're saying, Jason, just throw on the afterburners of money and liquidity anytime there's a little bump in the road, causes all the other problems too that we come up with.
They become addicted to it. So you have to either, well, you don't have to do either one, but there's two sides to the coin, right? One is they're just going to keep providing it when there's a problem. So why ever bet that there's ever going to be a problem? Because they're always going to come in and solve the problem, right? There's that side of it.
Mm-hmm.
And then there is the doom side of it, which is at some point, it's not going to work, right?
Mm-hmm.
Yeah, at some point, there's a limit to how much money you can print before people stop accepting your money, right?
Mm-hmm.
And if we get to that point, then you might as well kiss the baby, right? Because it's all
Yeah.
over. But they will go down fighting, if it's all going to be over, they'll go down fighting, right? They'll just keep printing money and keep printing money. So, but at some point, and I always say, I don't know if that point is this week, this year, this decade, or this century, right?
Mm-hmm.
I don't know what the limit is for how much money the U.S. government can print. I know there is a limit. There's a limit to everything in the world. Physics will teach us. But I have no idea what that limit is. But what I do know, or at least what I believe, is the markets will let us know. And I say that about everything, right? You can
Mm-hmm.
think this and think that and believe this and believe that and have a theory on this and have a theory on that. The markets will let you know if you're right or wrong. And the markets will let us know when they can no longer print money because it won't help anymore. Because they will print money and the markets will reject it. The dollar will get crushed. The bonds will get crushed. The stocks will get crushed, which is the market saying, it ain't working no more.
Well, I think in
So
the
you don't
short
really
term
have to
here,
worry about it. You don't really have to forecast it. You don't have to know that it's a possibility. Know what's going on so that you can know what the markets are then saying about it. I think that's the key to it.
I think in the short term, I don't know if you agree with me, but looking at IBIT, which is ETF, I'll trade if I want to trade crypto, for Bitcoin rather. We had the highest volume on record of the ETF going back to its IPO. We had the big gap down, upside reversal, which is following through today. We saw similar with like a core weave, all the other suspects we want to point out to, which had big slams. Even stocks like BE, which is a AI energy play, we had like massive sell off. You can see here these are tremendous moves with big volume kind of come in. For me, I think these, including Oracle, these are the stocks to watch to see if the trouble is starting to be snuffed out. I think looking at, like I mentioned, Blue Owl Capital, the fact that this hasn't broken its last Wednesday's low is important. I think step one is these need to like at least stabilize before we kind of see real strength come in. But just the fact that at least these can stabilize for me is the key about whether I want to keep putting exposure on the market. I'm looking at it as a possible climax bottom last week in the short term. If these bottoms break, then I think liquidity's drying up a whole lot more, and we need Powell to kind of jump on the dove boat or we're in trouble. But looking at it just from the volume and price perspective, I see a possibility that as soon as all the bad news hit the wires, of course, it would be such the typical irony as usual. But as all the news hits the wires, that maybe that was a climax sell point. That's something I'll be watching.
Yeah, I think that Friday definitely had, from what I've seen, a number of those type of signals.
Mm-hmm.
Your classic sort of capitulation type of stuff. High volume, and like you said, IBIT, and some of these other speculative names and all that. We saw some capitulatory type of movement, I think. I don't particularly love it in this case, which isn't to say that I'm right, okay? But for me, as someone who does trade capitulatory type of turns, that's my whole trading style. This wasn't the greatest one I've ever seen because some of the things are there. Like you say, look at the chart that you have up, the volume on IBIT. There's no doubting that, okay?
Mm-hmm.
My problem with it, frankly, is that it was on bullish news. Friday was a day of bullish news, in particular on the liquidity front, right? Because the guy came out. The Fed guy came out and said, you know, he was much more dovish than was expected, and the chances of a rate cut in December went way up. Went from like I don't remember the exact numbers, but it was like 30%
Hmm.
to 70% or whatever, right? And people were getting worried about that. The liquidity was therefore drying up because of that. And as we said, the liquidity type of markets were going down because of that. So now they rebounded because the news was more positive. I would rather have it rebound on negative news. To
Hmm.
me, that's the whole thing, right? So because I can't forecast whether the news is going to be good or bad, you know, like if I
Yeah.
knew that the guy was going to say what he said on Friday, then I would have bought before he said it, right? But I can't forecast that. So the fact that the market reacted positively to that and is following through some today, it's better than not,
Hmm.
obviously, but to me, it's not the full answer. Um, from a more simplistic level, I'd like to see the Nasdaq close above the post Nvidia highs. Um, right, the
Yeah.
fact that it's higher than the day before Nvidia, I think, is the first good sign.
Hmm.
But and I'm not a technical guy, and I'm not. But if I do look at charts, my interpretation of charts right there would be, I think it needs to close above that post Nvidia number. That would be the first good bullish thing. And the range, in my view, being that high to that Friday low.
Hmm.
I think those are the two most important places on the chart right now. If I were trading charts, that's how I would be looking at them.
Yeah.
And
And
if you look at what rebounded the most on Friday, it was the stuff that had the most interest rate sensitive stuff. The
mhm.
Russell was rebounded the most, and the Dow rebounded the second most, and that's the most interest rate sensitive stuff. So that's how it should do. You know, the way that I trade, I don't want to trade things when the market's doing just what it should do. You know, I like to look for things when the market's doing what it shouldn't do.
Hmm.
To me, that's the tape talking, right? And that's the only thing that can kind of, for me, give me what I think is an edge, as opposed to, well, it did what it should do. Okay, well, I didn't know what the news was going to be, so I didn't know what it should do, and I'm never going to know what the news is going to be, so I don't know what it should do. So I can't find edge that way, but
Yeah.
it's good that it did do what it should do. Much better than if it had gone down. Even though the Fed guy was more dovish, that would have been horrible, right?
Right.
So yes, I think that what you're saying is right. There was some capitulation type of stuff there, and trading it against Friday's low is certainly if you're bullish, um, that's the trade. But if we do take out Friday's low, I think you got to take your loss and run.
Yeah. Yeah. Well, speaking of the Fed and money and all the rest to our prior discussion, I know you mentioned you want to discuss well, I don't know if it's the carry trade or the dollar yen. I know there was. Let me bring that up. There's a new Japanese cabinet in power, which they just okay. The first move is to okay this massive stimulus to kind of come out and help the economy, which is sluggish and not doing so well. They're having a problem with exports. I don't know to what extent that's because of tariffs or whatnot. I don't know. But let me bring up the dollar yen chart here and just oops, sorry. Just curious what points you want to discuss, what you want to bring up.
I mean, it's really just about the fact that you're starting to get a lot of bear porn about the yen carry trade, right? It's going to
Mhm.
blow everything up. The unwind of the yen carry trade is going to blow everything up. Can you make that go back a little further,
Sure. How far
like
back?
to like last summer?
Absolutely. Here we go.
Bingo. That's all we need. Okay. So, and I don't want to get too deep into it because I did do like a 10-minute video on YouTube this weekend about this. And if you really want to hear my whole rant about it, you can, I guess, check that out rather than waste so much time here. But in general, you can see back last summer where the yen, this is the dollar that you're looking at. So right there was a big move of the dollar going
Mhm.
down, the yen going up, right?
That's right.
And while that went on, the stock market had a pretty decent sized hiccup, bigger than the hiccup that we're having right now. And so people like to then say, oh, well, the yen carry trade is blowing out. The yen carry trade being real quick, the fact that interest rates in Japan were essentially zero for a long time. People could borrow yen at zero, switch it into dollars, put it into some dollar asset that was making a return, and then, it's sort of free money. And not only is it free money, but you've also got Japan and the Japanese not earning any interest on their bonds, so they might as well buy U.S. bonds or something. So it's a lot of money going the U.S. way. And when you're borrowing, just like when they're printing money, like you were saying, that creates more liquidity. So by borrowing all that yen and putting in other stuff, it's also a liquidity increaser. So if that's going to go the other way now, if now the Japanese government is going to start raising rates, which they said they're going to do, and they have been doing, and the JGBs are going to start to have a positive yield, which the yield on the JGBs has been going up, well, then that whole thing will reverse. Everybody will get out of bring their money back to Japan and all that. And we've heard a lot about that. And I'm just taking the other side. I think when something is so highly observed, it has less of a chance of being a shocker. Yes, last summer it was a bit of a shocker because Japan came out and started saying that they were looking at raising rates. And it's the first time in God knows how many years, probably 30 years, that they were talking about that. So it shocked a little bit. And the yen went up, and stocks came down for a little bit. Okay, and then stocks went right back up anyway. At the time, you don't have this chart, but again, you can go to my video or I show it. At the time, people were mega short yen. So when it turned, there was a big move the other way. They're nowhere close to short yen like they were then. So I can't see it having that big of an effect. So I just think it's bear porn. Could it happen? Yes, anything could happen, right? But I think the odds are low, a lot lower than they were last summer, based on positioning, based on the psychology. So all I'm really trying to say is don't trade based on that idea, because it's just more bear porn coming from more ignorant perma bears who are just consistently looking for a reason why things are going to go down. Does it mean the market can't go down? No. But I just don't think that this is the thing to be focusing on, is my point. I'm focusing on the fact that it's not the thing to be focusing on.
Yeah. And, just to the other side of the argument, the U.S. economy, the Japanese economy's kind of been slowing down. They also, to our discussion last week, we were saying so much of the annual returns of the indexes is based on, productivity, inflation, and population growth. Well, Japan has a slowing economy and they have a falling population. So that's a naturally deflationary force, which the U.S. doesn't have, so which is part of why there's always that kind of imbalance between U.S. and Japanese rates and that carry trade. So,
well, the last thing I'll say about this whole thing, which is the funniest part of it all, is that the stock market has been going down for the last few weeks.
And this has gone up.
Yeah, but the yen's been going up.
Yeah, accelerating.
I'm sorry, the yen's been going down. Yeah, accelerating, right? Yeah. So you're not going to blame it on that. You're not going to say the stock market is going down because the yen carry trade is blowing up, because the yen carry trade is actually working better. Yeah. So I don't know how you can say that. And in fact, Friday was the first day that we actually saw the yen go the other way, which is supposed to be the bearish way. And that's the day that stocks bottomed, at least to now, right? Stocks went up on that day. So the whole argument to me is silly. And like I always say, the market, it's not me necessarily saying it's silly. It's the market saying it's silly. If the market starts to say that it's real, then okay, maybe I would believe that it's real. But until the market says it's real, I'm not going to believe it's real. It's just more mental masturbation, speculation of the future that people are trying to sound smart about, and the market is making them look stupid, as it usually does.
Perfect, Jason. Are there any other charts you want to kind of cover before we wrap up for the week?
So just to follow up on what we were talking about with coffee last week.
Oh, that's right. Let me bring that up here 1 second.
I know nobody or very few people are really going to care very much about coffee, okay, in itself, but I think that there's some very important lessons here. On Thursday, after the close, Donald Trump signed an executive order that was going to take away any and all tariffs on coffee. And coffee, as you can see, gapped down a massive amount and then came right back and closed way below that low. Last week I was talking about that that candle from like 5 days back, that reversal candle, which happened on the day that they announced two more to the right.
This one
No,
here. To the
the
right.
other way.
Here. This over here.
Right. So that reversal candle happened on the day that they started talking about the fact that they were going to put tariffs or take away tariffs on coffee, and the market reversed. And okay, then they actually did it on that last week, and the market kind of went down a lot, but closed above the low of that candle, which to me is positive. So, and today it's kind of following through the upside. So I just think it's interesting because there's this whole battle going on here, in my view, based on the Trump administration, where the respect for the power of free markets is put in doubt a little bit, right? In a lot of different ways, meaning they can print as much money as they want and it's going to be nothing but positive, right? That to me is a little bit disrespect for free markets, because at some point the free market would say, well, you cannot print an unlimited amount of money, right? Otherwise we're going to start rejecting it. Okay, but we see it in a lot of different things, and it has worked, quite frankly, for the most part. They wanted the price of soybeans to go up to help the farmers. The price of soybeans have gone up. They wanted the price of cattle to come down because everyone was freaking out about the price of steak. The price of cattle has in fact come down, right? They want stocks to go up, stocks go up. They want, interest rates to stay calm. They've been able to, because they are City Hall, they have in fact been able to sort of get markets to do what they want them to do. And that's fine. But I am always interested, because of my belief in economics and the science of economics. I believe that in the end, however long that might take, economics will win out. So I'm always interested to watch when the markets do what these people who think they can bully markets don't want them to do. I'm consistently on the lookout for that type of thing, and I think that that's exactly what happened in coffee on Friday. They want the price of coffee to go down. They did what they could do in order for it to go down, and it went up anyway. And it's going up anyway. So it's not so much that you necessarily have to trade coffee or whatever, but it's just an interesting thing to observe, because I think we need to start observing this happening or not happening, whether it happens or not, across all of these assets, because so many of these things are being willed by the current administration. So
I
what
think to your
happens?
point, one thing that's given this administration a big help has been the AI revolution, and just the amount of capex spend, and how the U.S. has been, there's the two leading powers, China, U.S., and the U.S. is on the Western side of the world. Even, Europe would, when it comes to data and all the rest, would rather work with the U.S. on that kind of growth. And it looks like even Middle East, Saudi signed some big deals. So that's been, if you're going to want to print a lot of money, at least if you have a new growth driver. But I think if you look even at year-to-date returns, and you look at, let's say, Triple Q, which year-to-date is up, if we can get a percent up here. Not sure why it's not giving me. Anyways, this is maybe mid-teens, and if you look at whether, let's say, small caps, I mean, these are like barely trying to get to green on the year. They're fighting to be positive. They haven't had the tailwind of AI and all the capex spend. These are the smaller businesses and all the rest. So I think that's been a big help. I think that's why it needs to sustain itself. That's why I'm watching closely those other liquidity trades we spoke about, because the AI trades have run into the wall of the need for money, like you mentioned. I think it's a good microcosm of your point, where people were believing everything that they wanted, but when Oracle finally went out to kind of go borrow a lot of the money, and their credit default swaps were starting to tick higher, then suddenly everyone kind of panicked and ran the other way. So I think just to see how those dominoes can continue to roll, and what the greater impact is going to be important to watch. So
No, I
interesting.
think that's an important point. Whether or not you like the Trump or the administration, or you believe in what they're doing, blah, 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 blah. At the end of the day, they could just get lucky because of the AI revolution. You know what I mean? Things could just get better, and things could go up, and the economy can grow, not because of them and their policies, just simply because we're going through maybe the biggest revolution, the productivity revolution in the history of mankind. It could be just that easy, which is why, like I keep saying, the two things that I continue to watch is how AI reacts the AI stuff reacts and how liquidity is. To me, those are the two things, right?
But just a counterpoint there, if let's say, I find, the population has become more divided politically than ever before. If you're on the side where, let's say you don't like Trump or the administration or their policies, and there is a genuine revolution going on, it's easy how you can kind of get the bias of like, oh, things can't get better because I don't like these policies, when in reality, that doesn't make the AI revolution not true, or not that anything can go at any time. But I'm saying if you're going to bias or you're going to bring together these correlations into a causation that doesn't exist, you can stay bearish and pessimistic and miss out on a massive opportunity for a reason that was completely independent of the outcome of the other. So just trying to
Exactly.
avoid as well, to be very
It's a
important
great.
to be aware.
That's exactly what you just said. There, it's such a great lesson, right?
Yeah.
Um, Things can happen for one totally different reason than you were even looking for, right? And
Hmm.
that's usually what happens, right? Which is why, quite frankly, the ultimate answer to all of it is the tape, because you could be as bearish as you want because you hate Donald Trump, you hate Donald Trump, you hate Donald Trump, you think his policies are horrible, so you're bearish, you're bearish, you're bearish. But the market keeps making a new high, so the tape is telling you don't be an idiot. You know, I
Yeah.
can make these arguments both sides. Like even that Saudi thing that you mentioned, I was thinking about this week, and it cracks me up. The guy sits down with the Crown Prince of Saudi Arabia, and while he's sitting there, he's like, oh, whatever. I forget the number. I think it was like $600 billion. They're going to invest $600 billion in the United States, and then the guy goes, actually, we're going to up it to $1 billion. So he just made the decision when he was sitting there that minute that they're going to go from 600 billion to a trillion or what? Like, what? Like, is
Yeah.
this really how these decisions are working? Because I don't believe it. It sounds like a bunch of crap to me. And is anybody actually auditing this stuff, like this 600 billion or whatever it is? Is it actually being invested? Like, do we know that it is? I don't know that we know that it is. I think it's all. I don't know what it is, and I don't know if there's any way to know what it is. So could it be could it be 100% bullshit? Yes. Could it be 100% real? Yes. I don't know, and you don't know, and nobody knows, right? But if you don't fight the tape, it doesn't matter.
Yeah. Yeah.
I,
Perfect.
I I know it gets boring me saying that all the time, but I'm going to say it all the time because it's the single most important thing that there is.
Well, it's the quintessential lesson of trading. If you fight it, I mean, that's at the end of the day, that's the most important thing. I'd rather, the old saying, I'd rather be lucky than good. You know what I mean? It's like you want to be on the right side of the tape, whether or not the reasons you thought it was going to go that way are true or not. So it's
That's right. If you if
100%.
you if you let the tape tell you what's good and what's not good, you're gonna get lucky a hell of a lot more than you ever did before.
Awesome, Jason. Well, we'll check back in on all those liquidity plays next week and all the rest. We'll check in on coffee and the carry trade as usual was a lot of fun and looking forward to next week. Thanks so much, Jason.
Awesome, man. We'll talk again next week. Have a good one.